Hello and welcome to Morning Trade with Moneycontrol. I am Nandita Khemka and I'm here to help you navigate the trading day with actionable trading strategies, with the sectoral trends that you should be watching out for, and of course the queries that you will be sending us on our live feed, and we will be getting them addressed by our expert on the show. But before we get our experts and decode the market setup, let's take a look at how the global handover is looking like this morning. Well, Wall Street snaps two-day winning streak with losses accelerating towards close. US Treasury yields rise. Meanwhile, positive cues coming in from Asia this morning as all markets trade in the green. SGX Nifty indicating a higher start for the Indian market. European markets closed mixed on Monday as investors assessed recent US inflation data alongside a warning from a top Federal Reserve official. And should you still be cautious of the market at current levels? Also in focus today will be Mindtree, apollotyres and Balkrishna Industries. Well, we're now joined in by Ajay Bagga to discuss whether or not the investors should turn cautious in the current market setup, which is just a whisker away from record levels. Well, good morning, Mr. Bagga. Good to have you on the show. Well, the markets are inching towards record highs. Do you think the valuations are getting too expensive now? Is it time to turn cautious?
Valuations, Indian valuations are always at a premium. Valuations, I'm not so worried about. What I'm more worried about are the global cues. So the problem is not going to come from India. The problem, as has happened across the last 1 year, right from last October when the FIs became major sellers, we have seen some amount of inflows starting again in July, August. We got inflows, and September was bad. Again, October has been good, and we are expecting November to be a blockbuster month. But we don't see those to continue for too long. So the issue will be more global. The Fed rate hike and the dollar level is the biggest issue. The inflation in the developed markets is the third biggest issue. India, we are quite optimistic on, but we will find a speed breaker because of the global cues.
Right. You said we will find a speed breaker because of global cues, but given the fact that inflation in the US has eased off a bit and signals coming from some Fed members that they may be looking at slowing down the rate of interest rate hikes, in light of this, do you expect the FI flows that we have seen coming back into the Indian markets over the last couple of months or so to actually pick up from here? You've said that November will turn out to be a blockbuster month for FI flows, but don't you think that should continue into the next year as well, given the fact that rates may actually rates may ease off a bit, if not inch too higher from here?
Yeah, they will inch higher. They're not going to ease off. So December, we are expecting a 50 basis point hike, and on Feb 1, another 25 to 50 is our expectation, with a terminal rate of at least 5, if not 5.25. So it's not going to ease off. There will be a pause. Hopefully by April, May. And then 2024 is when we are expecting an easing off. The good thing is the dollar index has reacted downwards. That's positive for emerging market flows. The second thing is the China stimulus. If the flows resume to China, we will get our 15% of the MSCI emerging markets index. So emerging markets tend to do well at this stage of the market, so we should get the normal flows coming back to India. Even if that doesn't happen, the domestic flows have been strong and we have held up thanks to the domestic flows. What I'm cautious about is earnings degrowth, especially in the US. So earnings coming down, that re-rating will have a bad impact on the markets. And second will be the threat of a recession. UK recession is more or less 100% sure. You will have a big probability of a European recession based on the energy prices, and about 1/3 of a percent probability of a US recession sometime towards the end of next year. So these are the big global factors which are weighing even on our markets. And in that kind of a scenario, we could get coupled with the US. and you could see some outflows. Seasonally, this is the best time of the year for markets. So about from mid-October to early Jan is when we really see markets outperforming. The Santa Claus rally also comes in. There will be some amount of buying also going into the year based on reallocation flows. That I think should get done by December 15th. So next couple of months might be good for the markets. We'll probably make lifetime highs again on the Indian indices. But where the global markets are coming off very sharp corrections, are seeing a bear market rally, we are at all-time highs. So there is a big dissonance. And normally that will again start reverting to mean. So I'm saying maybe Jan and early Feb, we see some kind of correction in global markets and our markets follow through. For us, budget will be there. That will also have an impact. We are expecting a welfare-oriented budget, a re-election 2024 oriented budget. So don't expect too much for the corporate sector. Expect a lot in terms of welfare measures. Hopefully something is done to ease the tax burden on the middle class as well. Higher fiscal deficit will be expected, higher food and fertilizer subsidies. That could be one trigger, for example. I don't know the trigger sitting here today, but around February, we are expecting markets to get a little weaker. So no shorting of the markets, but no, using all the cash you have to get in. I think in a very measured, calibrated manner, from here to about May, money can be invested into the Indian markets.
Right. What are the sectors that are looking most attractive post Q2 earnings, given the fact that there weren't really any major disappointments from the quarter gone by? In fact, both private and PSU banks have done well. So which would you prefer, given the fact that even the elephant in the PSU banking pack, SBI, has started to dance?
Yeah, that's very well put. I would say private sector banks still they're going to eat market share, and you saw the correction yesterday, mild one, because so much run-up had happened. So that was a reversion to mean. But private sector banks will lead this part of the rally. Capital goods are looking very good. So domestic cyclicals, that's what the focus should be on, because the global remains a question mark in an economy sense. Even though, we saw some recovery in the US markets over the last week, and, especially Thursday, Friday, after the US CPI, we saw the best two-day returns for NASDAQ since 2008. But these are bear market rallies, which tend to be very sharp. And when they turn, they give a lot of destruction. The last part of the bear market is the worst. It gives you the sharpest falls. We have not seen a confidence capitulation, which always happens towards the end of a bear market. We use a rule of 20 to call a bottom on the S&P 500. It's worked every time since 1926. The rule of 20 is very simple. The price earnings ratio plus the CPI headline number should be under 20. That's when markets tend to make bottoms. It's still running at 26, 28 range. So we are still some way off the bottom in the US market, and that will really lead the way. The good thing is about 3 to 4 months before the recession's onset, the markets would have bottomed. And in the middle of the recession, markets will start picking up. And by the time the economy turns around again, say in the middle of 2024, as the US economy takes off, as Fed cuts rates, markets would have already given you most of the gains of the next cycle. So it's coming. It's a few months away only, the market bottom. And that will be a good time to get in. So the next correction, if we get about 3,000 on the S&P 500, 3,000 to 3,200 would be the range of the market bottom. That would be a very good entry point. Will the markets give that to us? Right now, it doesn't look like. We are thinking CPI has kind of plateaued. Rate hikes are going to pause, go slow. There's a lot of damage that's already done. But what we are missing here is A, it always works. Second, earnings have to fall. Earning margins are coming off. Third, the US consumer has been very resilient because of the COVID cash that was sitting, but it has been a K-shaped recovery. 60% of US households are living paycheck to paycheck. And right now there are 10.7 million job openings versus the unemployed being at 5 million. So it's a 2:1 ratio. Right now, it's a surging economy in the US. 2.5% growth is very high for a US size of economy. That is going to turn over the next 2 quarters or 3 quarters as unemployment picks up. Our estimate from the Phillips curve is you will need an unemployment number nearer to 6% as against the Fed's projections of 4.5, 4.7 doing the trick on inflation. That's not going to happen. You'll probably be near 6% unemployment, which is a lot of pain ahead. And that is what will be the overhang on the market. So you got valuation correction based on interest rate hikes. Now you get the earnings correction. And then the recession comes. And that's the classical cycle. There will be variations, small variations. But if you look on a 3-year, 4-year cycle basis, this is how at the end of 3 years, we'll realize this is how the cycle played out. So we are in the second innings, just started, and the third innings will come sometime next year. But not to worry, it's about 6 months away. Most of the damage is done, maybe another 33% of the damage. So if you're down 20, 22%, it will go down another 10% from there. A total 30% is the classical bear market in the US. Most of it is done. India is in a sweet spot. Our flows should recover. As the dollar falls, EM flows will recover. India will get 15% of those. And our economy is stronger. But and normally, the year before the national elections, we tend to do well. So we should have a good year next year.
Right, Mr. Bagga, right. I just want to ask you one last question. What are your thoughts on these new age companies? We saw most of them reporting a fairly decent set of numbers. If not very good, it wasn't as bad either. And given the fact that Paytm also believes that it is on the path to profitability, and we saw Nykaa also, in fact, reporting a great set of great profit growth compared to last year. So what would you suggest investors do with these stocks?
Stay away. Right now is the quality time. And so go for the positive cash flow companies, the dividend paying, high quality companies. You want to play the growth story played through the small caps, again, which are positive cash flow. 1000 PE or infinite PE companies just don't make sense, especially in this new reality where the cost of funding has gone up. RBI is not done with rate hikes. On December 4th, 5th meeting, we are expecting another 35 basis point hike, and February another 25. So terminal rate for India, we are expecting to go to 6.5%. And you add that on for cost of funding. So it's not going to be so easy to get incremental funding to fund all the losses these companies are making. The ones who are profitable are at 1,000, 1,100 price earning ratio types. So you are paid for the next 20 years of growth already. What do you get as an investor unless they can do 20 times the present profits? A few Amazons and Teslas come by once in a generation. I don't know if any of these are those, and it's too big a risk. So you want to have a stake, maybe 2% of the portfolio can be allocated to the better run companies, but otherwise stick to quality. This part of the cycle next 2 years is stick to quality on the large caps where you have...
Mr. Bagga, we're running out of time here, but thanks a lot for taking out the time and sharing your thoughts with us this morning. Well, with that, let's move on to our next guest. Nirav Chheda of Nirmal Bang joins us now. Good morning, Nirav. Good to have you on the show. So we saw some bit of consolidation in the markets yesterday, but this morning, once again, SGX Nifty is throwing up positive signals. What is the setup looking like for the day?
Yeah, good morning, Nandita. See, good you asked me this. Very importantly, one thing here is to note that Nifty had fallen from 18,580 odd levels up to 15,200. So in the last about 6 months, there has been a tremendous recovery. Most important levels were the 50% retracement, which was around the 17,300 odd levels, and then 16,900 levels, and then the 78.2% retracement, which was around the 17,800 levels. Both of these have been crossed, and now Nifty is going for that 100% retracement, which is around the 18,550 600 odd levels. So I believe, yes, Nifty should go there. The cues for the morning are positive. We are opening on the positive note, and you are seeing broad-based buying in most of the sectors and stocks pertaining to Nifty at least. So I believe even if we open up today, we will see further buying coming in, and Nifty, making a move towards the 18,500, 550 odd levels for today. Having said that, 18,300 is a very strong support now. If until that is broken, you will see some bounce coming in for Nifty from those levels. Two, three things to note here is the VIX. India VIX was above the 20 levels for most part of the last year. From October last year to about now. In fact, for the last 2 years, it was near about above the 20 levels only. That has come down towards the 15 levels, and this has happened after a period of 2 years. So generally, whenever this VIX comes down below the 15 levels, you do see a broad-based rally like the one which we are seeing right now, and it's a linear rally where the index also moves up. So I expect positive things to come up for Nifty. Again, PCR is at comfortable levels. Open interest is again soft. It's not high. It's only about 1.4 odd crores on the Nifty index, where at the peak time it used to be above the 2 crore mark. So it's still at comfortable levels, and I believe further buying should come into Nifty even for today. 18,300 is the support, and 18,500 and 550 other resistance with a positive bias.
18,000 to 18,500 on the higher side for the Nifty. Well, let's talk about some specific stocks. Then L&T Infotech and Mindtree merger has come into effect, and it has become the fifth largest IT company by market cap. Now, so every 100 shares of Mindtree will fetch somewhere around 73 shares of L&T Infotech. In fact, we are getting a lot of queries on these stocks as well. Prabhu has written in, and he wants to know whether it is time to buy into these shares. What would you suggest?
Yeah, so more or less now both these stocks will move together, until the merged entity becomes one, at least from the trading perspective. See, again, in the IT sector, what has happened is in the last 1 year, there has been a tremendous amount of selling. So, LTI, for example, it had gone to about 7,200 odd levels. It has fallen to about 4,000 levels in that 1 year. And then, a breakout has come in. The breakout has come in around the 4,800 odd levels. And similar is the case for Mindtree, again, from 5,000 odd levels to 3,000. So, for the whole year, they were doing a lower top and lower bottom formation, and that has been broken. A downward sloping trend line breakout has come in for both. So both these stocks should move up at least 5 to 10% here. Also, add to that, for this expiry, the IT index as a whole has seen a lot of short covering. So, the shorts are almost out of the system and longs are being built in. So definitely, I believe these stocks should do well, and all the IT stocks should probably move up another 5 to 10% from here.
Right. Let's move on to our next query for today. This is coming in from Ayush Shetty, and he has a query on Tata Motors. Now, over the last 1 month, we've seen returns to the tune of somewhere around 10% from this counter, and even in yesterday's trade, it was fairly buoyant. What would you suggest him to do?
See, Tata Motors looks like it is stuck. It's a long flag kind of a formation. Now, this formation breakout is above the 475 levels. Until that level is breached on the upside, you will see, this stock getting a big hurdle or big selling pressure around the 460 to 475 range. It is still at 430 levels, but I'd say, avoid buying this counter. If possible, look to book profits as it comes up towards the 460, 475 levels. Only buy once this 475 level breakout comes in, because after that, you will see a big move in this counter and it will go for its all-time highs, which are placed, roughly around the 600, 650 odd levels. So it can be a good upside after that.
Right. The next query comes in from Trilok, and he wants to know your views on SBI and ICICI for the long term as well as the short term.
Yeah. So, see, very good stocks to pick actually for long term. I should tell you, both these stocks in the long term have very good chart patterns. Also, open interest profile is very positive. You are seeing consistent, addition in open interest in both these counters. Also, delivery have gone up. So now, for the longest time, SBI was trading in between 360 and about 150 odd range. So it took about, more than about 10 years of consolidation for this particular stock. And post this consolidation, this stock has still gone just, about 1x or probably 2x. But I still believe, this stock can go up toward the 800, 850 levels, looking at the pattern. Whenever such consolidation comes in, the aggressive move is at least 3 to 4x. So I believe 800, 850 levels can be reached. So look to buy SBI. You can keep a stop loss of around 530 for your long. Even if it comes down to 550, go ahead and buy. A very good pattern. Also for ICICI Bank, this stock is now taking leadership positions. The volumes that this stock is actually witnessing are tremendous. I really like the whole pattern that it is making. It is now in leadership position in the banking space. So it's a definite buy. So you've got a good, downside, which has happened in the last couple of trading sessions where the stock has come down from 930 or to about, 890 odd. Look ahead, buy this stock, even if it comes down towards 840, 850, it's a good level to accumulate. You can keep a stop loss of 820 for your longs. I believe this stock is headed towards 1400 to 1500, looking at the overall pattern and the open interest profile.
Right. The last query for today is coming in on Sona BLW. Jiffin has written in and he wants your views on this. Now, this stock has been in a steady downtrend, shaving off somewhere around 40% or thereabouts on a YTD basis. What would you suggest he does on this stock?
See, generally, what really happens is once the stock is up, there are cycles that play out. So once that top is made, there's generally a 12-month to 15-month gap, after which, the uptrend again takes shape. So this stock has started to come off from January of this year and, of 2021. So, this stock has generally taken more than 15 months now. So, the next real cycle to play out should be after 24 months. And, it's about a couple of months left for this stock to play out its cycle. It should be in consolidation for that much time. But the good news is that I am seeing good volumes at the lower end. So from 600 to 450 odd, the volumes have risen, and which really indicates that, the accumulation phase has started for this particular stock in the long term. So this is a good level to get into the stock. But don't think short term in this stock, because in short term, I don't think it is going anywhere. This stock will run up again towards the 700, 800 levels in the next 6-8 months, but it will take at least 1 or 2 months to take off.
Right. Well, this wraps up our query segment. But Nirav, before I let you go, do share your recommendations for our viewers this morning.
Yeah, so these recommendations are for 1 or 2 days. The first one is Cummins India. Now, see, Cummins, most like as I told you about SBI, what has happened is, after a period of more than 6-7 years, the stock has witnessed a breakout above that 1200, 1250 levels. That was a very important level for this particular stock, and that level has been breached. So whenever such a huge 5-7 year consolidation is breached, the move after that is huge, and I expect a very big move in this particular stock. Even from a 2 day perspective, this stock is very positive. I believe this stock is headed towards 1410, 1420 odd levels. So look to buy this stock at current levels. You can keep a stop loss of 1315 for your longs, and 1410 should be your target. The second stock is Vatek Wabag. Now, see, this stock has been in consolidation for quite a long time, but recently this stock has witnessed a breakout, coupled with good delivery volumes, I believe this stock is headed higher. A downward sloping trend line has been breached around the 275 levels, 280 levels, approximately. This stock can go towards 360, 370 levels in a month's time. But from 1 to 2 day perspective, I believe 320 is coming soon. So look to buy this stock with that target, and your stop loss can be around 280.
Right. Thanks a lot for sharing your thoughts with us this morning, Neerav. Well, with that, we are completely timed out on this edition of Morning Trade. But don't go anywhere, because coming up next is Markets with Santu and CJ.